I'm getting a lot of inquiries about what the real estate market's going to do. Are we going to have another crash? Is it worth it to buy now or to wait? My name is Ron Henderson, President and broker of multi-real estate services in the San Fernando Valley of Los Angeles. I'm going to cover some historic and economic elements that's going to show where we're at and where we're going to go. Real estate is hot across the nation, but the markets are regional. What we're going to do is concentrate on the San Fernando Valley and the Los Angeles numbers. I'm going to use a logarithmic chart of the San Fernando Valley residential prices going back to 1959 through 2020 to guide us through the history of the prices. The logarithmic chart uses percentage of change and is a better representation of value history. It basically takes the noise out and the visual inaccuracies from using basic numeric plots. Just looking at the big picture before we dig into a few specific periods, we can see over time, even though we've experienced a few dips, property values have gone up. One extracurricular item I'd like to point out is we're not taking into account basic inflation rates. But obviously, if you buy a property at any point historically, property values have increased over time and property owners have accumulated equity. Now let's dig into the history a little. From the 1950s through 1981, there was steady appreciation. Now, 1979-1980, the CPI or inflation rate hit 13%, and the 30-year fixed mortgages hit 18 to 20%. We started using adjustable rate mortgages, and that helped keep property values fairly stable. In the 1985 to 1990 timeframe, the rates came down to 10% for a 30-year fixed, and the local economy was very strong. Now, a quick story behind this big recessionary drop. Before I got into real estate as a vocation back in the mid-1980s, I was a quality control manager for an aerospace firm. Around 1988, I get a call from an associate that was a vice president at Lockheed. He gives me a call and says, "Hey Ron, you got to sell my house in Calabasas." I asked him, "What's going on?" He goes, "We're getting out of here. It's too difficult to conduct business in California and we're bailing." So he rattled off 3 or 4 locations. They ended up relocating to Marietta, Georgia. And he goes, "We may be the first, but we won't be the last." So during that time frame, a lot of primary contractors for aerospace left the region. And aerospace built the San Fernando Valley, starting back in the 1940s. So when they left, it subsequently took thousands of good-paying jobs with them. From 1991 to 1997, there was a national recession where the San Fernando Valley was the epicenter of the economic problems. When it finally felt like things were starting to turn around, we got hit with the Northridge quake back in 1994. This pushed many of the over-encumbered properties or the laid-off property owners into a foreclosure or short sale position. From 1997 to 2007, property values were off to the races. Loose underwriting guidelines added to the fire. Basically, anybody that wanted money could get it. Then it was like somebody flipped a switch. It went from too easy money to near impossible. The secondary money market for mortgages blew up. We had the implodometer, where we can actually see how many lenders went out of business daily. The housing and financial system was the centerpiece of the big recession. Property values would drop 40% over the next few years. The Federal Reserve would drop their Fed funds rate to 0 and started the experimental process of quantitative easing, which we'll talk about again in a little bit. Basically the same as what's going on now, but we're in a very different economic environment. Now, 2011, 2012, property values finally started stabilizing. Foreclosures were in high demand by the general population, but the government agencies and the banks, in their almighty wisdom, decided to sell off the foreclosures in bulk to foreign investors and Wall Street firms, just to get them off their books. The real estate market took the rest of the decade to heal from the last recession. New regulations like qualified mortgage and ability to repay portion of Dodd-Frank made it so lenders would have to extensively scrutinize a borrower's ability to repay. It was near the opposite of what was happening prior to 2007. Now our current scenario. The real estate market was stable, with moderate appreciation coming into January 2020. Then here comes COVID. Unlike the 1990s or early 2000s, the economic issues this time were not created by the market. It was created by the government requiring the population to stop gathering and shutting down portions of industries to try to fight this pandemic. To offset the slowdown in the economy, the Federal Reserve went back to the prior recession playbook. They dropped the Fed funds rate back down to zero, and they're conducting quantitative easing again. The Fed is buying $120 billion a month in notes and mortgage-backed securities, artificially forcing mortgage rates to historic lows. Over the past year, we have winners and losers. Some small businesses, those in hospitality, restaurant, and entertainment industries are getting killed financially. An abundance of people in other industries and those that can work remotely are doing really well and taking advantage of low interest rates. The problem is inventory. It's hard to be a buyer in this market. Compare the approximate 1,500 units for sale today to the 12,000 properties that were for sale back in 2007, the beginning of the last recession. There are several elements in play. In the past, homeowners would move every 7 or 8 years. Now it's around 13. Some of that is people aging in place, and some of it's due to lack of inventory. If you sell, what if you can't find another replacement property? The level of development hasn't come close to what's been needed to keep up with population growth. Back in 1969, the state was smart enough to pass the RHNA, the Regional Housing Needs Allocation, where the cities and the counties must adequately allow private developers to address the local housing needs. 97% of the state has failed, including Los Angeles. Between tight regulations, high development costs, and NIMBYism, LA has been tens of thousands of units short on what's been required to be developed for decades. Now, if you add in the generational element of millennials coming into purchasing prime time, regardless of politicians' sound bites and how they're going to fix things, supply and demand will be out of whack for the foreseeable future. The concerns that foreclosures are going to be a major issue after the mortgage payment forbearances are done are way overblown. You got to figure that the loan underwriting has been much tighter since the mortgage meltdown. The majority of loans in forbearance right now are going to have workouts negotiated, and there's been so much appreciation over the past decade that generally any distressed owner can sell, pay off the loan, and still walk away with some equity. Even though the Federal Reserve indicated they're going to keep the Fed funds rate at zero till 2023, it's the quantitative easing we have to keep our eye on. If the Fed sees strength in the economy post-pandemic meeting their inflation and employment targets, they're going to start tapering back on the QE, and the fixed rates will rise. That'll happen well before they increase the Fed funds rate. Not that the market needs stimulus to bring in buyers, but the Biden administration is talking about a $15,000 tax credit for first-time buyers and scaling back on the FHA mortgage insurance rate. What we need is inventory. We can expect property values to continue to appreciate at a fairly high rate for at least the next year. Two things we have to keep our eye on is when the Federal Reserve starts tapering back on the QE and lets the interest rates go to a market level, and the inventory levels. Even with a moderate increase in the interest rates and the inventory levels, we'll still see some appreciation and maybe a normalization of the market for a while. It'll actually be healthier. The real estate market is not like the stock market. It takes months for the real estate market to change direction. It's very momentum driven. If you're in the Los Angeles region, have any questions, or if I can be of service to you, feel free to contact me at the phone number or email below. Thank you very much. Take care.